Hi, Alex. Thanks very much for your question regarding a particular fund manager. The main problem with a lot of these funds is that most of their investments are in just 10 stocks, although they'll end up holding 100 companies, which begs the question, why do they hold so many, other than the fact that it churns and creates a lot of commissions and for the brokers that they have an affiliate link with. I don't like the fact that they just now pick the one that you happen to mention, and if we look at their top 10 holdings, it means you're paying a fee, rather large fee, for buying 10 companies you could have just purchased yourself in any event. You might say, well, they're keeping an eye on things, and that may well be the case. Part of the problem is, well, if the bulk of the performance is coming from 10 companies, and I think you should have about 15 to 25 in your portfolio, then the top heavy 10 that they've invested in raises another question, which is, well, of all the things, it's too narrow a group. I don't have a problem with, say, Lam Research or Visa, for instance, and the like, but you've only got 10. You haven't got a lot of other good quality companies you could have, and you're having to invest in some of the big mega cap companies because you're running so much capital. Here they're saying over £100 billion. You're running so much capital of the company. Sorry, the average market cap of the companies they're investing in is over £100 billion. So what about all the other companies below that? So you've really tied one hand behind your back, in that you're really restricted to a very small group of companies and very few of them. And as again, it doesn't take a genius to tell you that last year having 45% of your capital in technology was absolutely the worst possible thing to have done. In fact, energy, where they've only got 4.1%, was far better to do, and it looks like they've just completely missed that boat entirely, which might not have been the case had you been managing it yourself, and that was a lot clearer, and to be able to do that as well. So hopefully that gives you something of an insight of the problems I have with fund managers. I'm not picking on this one in particular, it's just that you happen to mention it, but it's characteristic of fund managers more broadly. That narrow concentration in very few, and then a broader portfolio, but often a few big calls on a few big companies and missing the bigger picture, which, as I said, last year was very much so energy stocks a lot sooner. And as you'll see, unlike you, they will very rarely go into much cash. They've got 4.8%. Now, people who held more cash last year did a lot better than the market. They did a heck of a lot better. And how did this company do last year against the market? Well, they were down. They lost a quarter of your pension last year. If I've read that correctly, they lost a quarter of your pension in 1 year. So, and you paid them a fee for the privilege of doing so. I'm not happy with that, I'm afraid.